You're watching the Money Show on ET Now, and let's get started with our first discussion. SIPs or systematic investment plan is one of the best ways to invest your hard-earned money in the equity markets. But when we talk about SIPs, usually the concept of SIP in mutual funds come to your mind. But SIPs in direct stocks are also gaining popularity these days. But remember, viewers, that SIPs in stocks and mutual funds are two different things and carry varying amounts of risk. So let's bring on board Arnav Pandya, founder at Moneyeduschool, to understand how mutual fund SIPs varies from stock SIPs and what should investors opt for and why. Thank you so much, Arnav, for giving your time to ET Now, and welcome on board. Firstly, because everybody who is not directly investing in the stock markets finds the SIP way quite convenient. So firstly, what's your take on the mutual fund SIP as well as stock SIP route, and how should one go about it in terms of the returns? What should be the expectation, and which one is a safer bet as for you?
So if you look at the basic term of systematic investing, the whole concept is that you put in an amount which is similar on a regular basis, with the end result that over a period of time, due to variations in the equity prices, you will get an average cost. Now, as far as mutual funds are concerned, we are very familiar with the entire SIP process, where every month, for example, you put in a specific amount and then you get units against this. But the main important factor when you do an SIP in a mutual fund is that you are getting exposure to a complete portfolio by investing in the units. So that is point number one. Now, the same thing when you try and replicate with respect to a stock, the basic concept remains the same, which is that every month, for example, you say, I will put aside a specific sum, and with that, instead of, say, a mutual fund unit, I am going to buy a particular stock. Now, the first difference that you will here see is that unlike a mutual fund, which can issue you units in decimal places and which will use up your entire money, you will need to do a proper calculation in terms of which stock you are buying and what is the price for it. Like, for example, say you are investing 5,000 rupees a month. Now, if the value of a stock price is, say, 2,200, what will happen is that you cannot buy a fractional stock in India. So you will have to buy 2 shares of that particular company, and 600 rupees will remain uninvested. So that adjustment you will need to make. That is the first thing. The second and most glaring difference that you will see is that instead of a diversified portfolio, when you do a stock SIP, you are getting exposure to just a single company. So there is no diversification, and your risk remain attached to what the company is doing and how it is performing. And the third thing which also you will find is that when it comes to a mutual fund SIP, you put it on automation mode. In a stock SIP, if you want to get that same kind of benefit, you will first of all need to have multiple stock SIPs to get a diversified portfolio. Second is that you need to do that effort every day, now every month, I mean. So now what you have a facility wherein your brokerage house itself gives you some facility to do an SIP. Still, you need to be very careful in terms of how you are going about it. So in terms of risk, there is a big difference. In terms of how your money is utilized, there is a big difference. And it's very clear that for a lay investor, in terms of process, the mutual fund SIP route is far easier than doing it on a stock.
Yes, Arnav, I totally get your take that for any new investor in the market, then SIP through the mutual fund route is quite easier and convenient to do. But Arnav, when it comes to stock SIPs, because when we host the query segment for the stock specific viewership, then they always ask that whether or not that on some stock where they are actually losing money currently, is this appropriate time to average this particular counter? If somebody has a long term view, then how should they go about with stock SIP? Because stocks are quite volatile, because that's just one particular counter where they are putting their money in comparison to a mutual fund where they are actually have exposure to a bunch of stocks. So when it comes to stock SIPs, how should one go about it? And if they are actually losing money in some of their long term bets, then how should they tackle that nervousness, if you can say? How should they play with that psychology and keep continuing with their SIP amount? What should be the strategy behind this?
So the first thing that any investor needs to do is differentiate between why they are doing the stock SIP. So stock SIP is not averaging out an investment just because the price has fallen. So there are two situations which investors face. See, one is where they've already made an investment, then they find that prices have gone down, but they think that the company is a good one, or they hope that the company is a good one and it will give them returns. So then they say that if that is the case, I will buy at a lower price, so my average cost comes down. That is a one-off thing. Now, when you are looking at a stock SIP, before making the investment itself, you are very clear that you want to build a particular amount of investment in that particular stock or company. And because you don't have the money upfront or you want to spread out the risk, what you will do is that maybe it will take you 1 year, 1.5 years, but slowly, every month by investing an equal amount, you will accumulate that amount with the hope that because you think this is a good long-term bet, then over the years, this amount which you have invested through the SIP will multiply over a long period of time. Now that should be the actual goal of doing the SIP. That because you have identified a very good company, you expect benefits to come over a longer period of time because the various plans or the way the company is running its business is going to do well. Then with that time frame of mind, you are going in and setting up a stock SIP. So this is not an opportunistic move that you are doing. This is a planned strategy, and your goal is to have a larger amount of shares which you have, because you do not know today. I mean, if you invest in any stock, whether over the next 3 months, 6 months, whether it will come down or whether it will go up. So, which is why the stock SIP will help you average out the cost, but the basis or the reason behind doing it has to be very clear, and it is a planned strategy.
Okay, Arnav, if somebody has to like start with the stock SIPs, then between the large, mid, and small cap, if they are looking for any investment in the stock SIP route, then how should they go about it? Because a lot of investors actually find it difficult to go ahead and actually find a good stock where they can have this particular strategy. So any advice that what should be the stepping stones for this thing to start this journey?
So ideally, I mean, these kind of stock SIPs are more suitable for large cap stocks. And the reason behind this is that, see, large cap stocks as a rule are less volatile in that sense. That, I mean, it's not like that they are moving up 30-40%, then coming down 30-40%. So one, mostly large caps are the one where you believe that these companies, because they are in a specific business segment or they are in a particular sector which is likely to do well, they are market leaders in their space, they will do well, which is the reason which makes you want to go and buy the company, and which is why you have started doing the stock SIP. So that is the normal way in which you go about it. But in some cases, if your portfolio demands it, and if you are taking a mid cap exposure, then maybe even a stock SIP in that segment is also done. But overall, what an investor needs to do is that they need to be very clear of what kind of exposure they are having in their portfolio. And why is this important? Because it's not just about one single investment and whether it will do well or not. Anytime an investor is looking to invest, they need to have a portfolio outlook, and that portfolio outlook needs to take into consideration what is their exposure across various market caps, what is their exposure across sectors. It should not be that just because you feel that there is one company in one sector which is going to do well, you have started investing in that particular company only. So it has to be in balance in terms of the exposure, because how much of amount you put in a stock SIP is also important. How many companies you select for these kind of SIPs is also important. So all that needs to be taken into consideration by looking at your portfolio and the various exposures that we have. That will determine how you go about this process.
Understand. But Arnav, lastly, if I may ask that if somebody is looking to go ahead with both these routes, mutual fund SIPs as well as stock SIPs, then how can they place their money in terms of bifurcation? Can they just go ahead with a 50-50 ratio, or any advice? Because I understand that it's a very individual sort of a call. Depending on their risk profile, depending on their return expectation, as well as the goal they want to achieve with the investments. But as a thumb rule, anything that they can follow in these lines.
So as you said, obviously, I mean, how much you money allocate where depends on an individual's particular situation. But you have to understand one thing, that you should not be replicating it. Like for example, you have to select mutual funds to do an SIP when you can't do the same by investing in stocks. Like for example, say in many cases, you might already have an exposure to large caps through one way or the other. So if you want, say, a larger exposure and you to the mid cap segment, then maybe you will be doing a mutual fund SIP. On the other hand, if there are some investments which are not likely to be made possible by uh, a mutual fund SIP, then you might want to go and do a stock SIP. Like for example, you might believe that one of uh, the large cap companies which you feel have a bigger potential, that is not adequately being invested into by the large cap or the flexi cap funds which you have. So if that exposure in those funds is extremely low or virtually not non-existent, then looking at that, you might want to do a stock SIP in that particular stock because you don't have an exposure to that in your portfolio. So this kind of balancing is required. The logic is that do not replicate what you already have.
Okay, Arnav, thank you so much for joining us today on ET Now and helping our viewers understand that what is the difference between mutual fund SIPs and stock SIPs and how can they go about it. Selecting one, what are the pros and cons? It was great having you on the channel. Thanks once again. But with this, we short break in this edition of the Money Show. Don't go anywhere. We have one more interesting discussion lined up with Shweta Jain. So we will be right back and you stay tuned with us. Welcome back to the Money Show, and let's get moving with our second discussion. And are you one of those who have never applied for a credit card or loan? If yes, then most likely you do not have a credit history. But remember, a good credit score is key to get a wide spectrum of credit cards and quick loan approvals. But to open the line of credit, you need to build a credit history the right way. And on to the Money Show today, we will decode what exactly is the credit score and how you can build a good credit score. So let's try to decode that, and let me welcome on board Shweta Jain of Investography. Very good evening, Shweta, and thank you so much for your time to ET Now. Firstly, let's start with the basics. Somebody who doesn't know about what a credit score means, tell us what a credit score is all about, as well as what is the likely range of a credit score, which credit score is considered to be the best one, and then maybe we can move forward on discussing how we can build a good credit score. So go ahead, and good evening to you, Shweta.
Hi, Srishti. Good evening. Thank you for having me on the show. So a credit score is a number, a three-digit number between 300 and 900 that tells institutions how creditworthy you are, right? So the lower your number is, the worse off the credit history is, or the credit score is, and the higher it is, the better it is. So it's basically a number that is issued by an institute like, say, a CIBIL, which gathers information about you, all the banking, financial history in transactions that you are doing. This information is collated and a number is assigned to you, and that is a number between 300 and 900. So all of your transactions basically that you are doing, any of the banking transactions that you're doing, will be taken into consideration when they are assessing what your credit score should be. So how does one build it? So one of the first ways that you can do is whatever transactions that you're doing. So it starts off with a basic bank account, right? So if you've never taken a credit card or a loan, it starts off with the transactions that you're doing, the checks that you're issuing. If you are bouncing off checks or writing more amount of payments than you have in your account. So if you have 5,000 and if you've issued a check for 5,001, it will get rejected, right? So if that is happening, then you will have a lower score. This is all the information that is going. Any of your SIPs, because I do know a lot of people start off investments immediately as well when you start earning. So make sure that all of your transactions are being honored and not getting rejected.
Okay, Shweta, thank you so much for that understanding. But Shweta, how can one go about if somebody doesn't know about that there's a credit score that is being maintained? How should one go about checking the credit score? Which are the sites that offer where they can go ahead and check the same? And also there are reports saying that you should not check your CIBIL score on a regular basis. So how correct is that, and what steps one should take to take care of that?
So that's a great question, Srishti, because people do want to know what their score is, because if you don't know, then how would you even work on improving it, right? So you can check on the CIBIL website and check your score. You can also check your score on websites like Bank Bazaar, etc. For free, some of these, but be aware that you're sharing your information with these websites. So they may push for loans or cards or policies or whatever, but these are places that you can check your history without it actually impacting your score. So there are two things when you're inquiring. There is a soft inquiry that you yourself are doing. So when you are checking on whether it's the CIBIL website or a GPay website, and for example, that also lets you check your CIBIL score, or a site like a Bank Bazaar. So you can check on your own by putting some basic information. That's called a soft inquiry, because you're not really applying for a loan or anything. Versus if you're applying for a credit card or a loan, they will check your credit score, which means that's a hard inquiry. So every time or multiple times, if you're doing hard inquiry, for example, if you're applying for too many loans or too many cards, then too many people are checking your score, your hard inquiry is happening. So that is how your credit score can be negatively impacted. So ideally, get one at a time and not multiple cards. So that will not impact your credit score. You checking multiple times usually doesn't impact the score because it's a soft inquiry.
Okay, thank you so much for that as well. But Shweta, if we can just highlight, because you were just highlighting that multiple people checking your CIBIL score may impact your rating. But the point being that if somebody is taking multiple loans at a time, so does that impact your CIBIL score too? And if he is already ensuring regular payments to the same, so will be any impact on the CIBIL score and any further loans that the person is in need with, any decision and any implication of the same?
So it does impact, because if you're applying for multiple loans, it does impact. Also, what impacts is not just your payment history, even if you're honoring everything, but if you're applying for huge amount of loans, if you are overextending yourself, it could definitely negatively impact your credit score.
Okay, Shweta, what will be the top 5 key takeaways from you in terms of how to maintain a good CIBIL score? In your answers, you have highlighted a lot of points, but if we just have to collect 5, what will be the top 5 priorities?
So one, when you're checking for your CIBIL score, check with the CIBIL website, not on any other websites, which may push products to you. So that is my number one point that I would highlight. Even if it's for free, It's absolutely fine if you have to pay and take it directly from CIBIL and not take for free, because they do then push products. Second is, do not apply for multiple loans at the same time. Take one at a time. Make sure that you're building a bit of a history and then apply for the next one if you can. Don't overextend yourself on especially credit cards, because it's really easy and they keep calling you and asking you to increase your limit. Do not do that. One, of course, you may be tempted to spend more, but the second issue is that if you are then going to take another loan, it seems like you're already overextending yourself, when in reality you may not be. So that's, I think, my third takeaway. Fourth is, definitely do not skip your EMIs or your credit card payments. Ideally, pay the full amount on your credit card bill. Do not look at the minimum amount that is due. So look at the entire amount that you can pay off. That is the fourth point. And the fifth point is, don't worry too much about this credit score all the time and keep checking week on week. I think that will only stress you out. Once in 3 months, if you're checking your credit score, I think that's good enough.
Shweta, but lastly, before I let you go, if somebody is taking a joint loan and two individuals have the different CIBIL score, then how does that impact the loan that both of these individuals can take, and how does CIBIL matters in this particular case?
So if there is a joint loan, definitely CIBIL scores matter for both of these individuals. But if there's one with a better score, that will definitely have a better impact than the one that is not having a good score. So anything above 750 is a great score. So anything about 650 is still a good score, but above 750 is a fantastic score. So if you're applying for a loan there, ease of access, ease of availability of loan is there. Your rate of interest is competitive. You can actually negotiate on interest rates. So you do have that advantage when even if you're a joint owner there, even if you're a joint applicant, that advantage is still there. It could pull you down a little bit, or your negative it could impact your negotiation negatively a little bit, but since there is a high score person there, it does impact positively.
Okay, thank you so much, Shweta, for highlighting all these details regarding the CIBIL score. But don't leave us, because we will get you back for answering all our viewers' portfolio-related queries. But before we take up that, viewers, it's time once again to slip into a very short break. Don't go anywhere. We'll be right back with more. Welcome back to the Money Show, and it's time to get all your portfolio related queries answered by the experts, because we understand that there are a plethora of funds that are available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio, and what are the criteria that you should be looking at? Let's try to get an answer to all your queries, and to answer the same, we are being joined today by Shweta Jain of Investography. And also, do not forget to send us your portfolio queries on a WhatsApp number, that is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. So that's the process, but let's get back to taking all your queries answered, and we have started getting live callers onto the show, Shweta. And with this, let me go across to Shashi Shekhar from Bangalore. He is live with us. Very good evening, Shashi. Thank you so much for calling us. Please go ahead. We have Shweta on board, and she is here to answer your query.
Thank you for taking my call. I have a small query. I'm a high-risk appetite person, and my age is 45. I would like to understand what should be the right asset mix between debt, short-term fund, corporate bonds, as well as the equity side, which is large, medium, and small cap, so that I get the best return in long term. My waiting horizon is approximately 5 to 7 years.
Okay, so you are looking for fresh investment, Shashi, is what we understand, in any amount that you have in mind?
Approximately 1 lakh.
Per month?
Yeah.
Okay, Shweta, you heard his query. Any more details that you are looking forward to, please go ahead and ask Shashi. He is online with us, but he's 45 years of age, high risk taker, and wants to build a corpus and a mix of many things in his portfolio, looking to invest 1 lakh per month. So what will be your advice in terms of the asset allocation?
Asset allocation for me, Shashi, is a part of where you have this amount available to you when you need it. So that would be your debt portion, and the amount that you need to grow, that would be your equity portion. So anything that you need within the next 3 years would be debt. So first, keep an emergency fund for 3 to 6 months of your expenses. So if your expenses are say 50,000, anywhere between so for 50,000, put anywhere between 1.5 to 3 lakhs in a short-term debt fund or a liquid fund. That would be good, so that in case you need, it's available to you. Anything that you need in the next 3 years, you could keep it in a debt fund. It could be in a high-quality debt fund that you can keep. It could be a short-term debt fund, be a combination of short-term and liquid fund. I still wouldn't recommend long-term debt funds for even 2 years, because you might need this within the next 2-3 years. So that would be your debt allocation. If this is say only 10% of your portfolio, so be it. If it is 40% of your portfolio, so be it. Rest could be in equity. Your time horizon doesn't seem to be much longer than 5-7 years. I would really like to understand why, because you're still young at 45. And you do have a long time that your money can stay invested when you can plan your cash flows and your withdrawals. So I would really urge you to extend that period if possible. And that is the money that can really grow into equity. So 5 to 7 years for me is the minimum time that you need to give equity. I would start off with, and I'm not sure what your existing portfolio is, but if you don't have an existing portfolio, start off with a passive fund. So your allocation between large and mid and small also you asked. So if you don't have equity experience before, I would urge you to start with 100% large cap allocation. So for a year, do your equity large cap allocation, and once you're a little more experienced, you can move into mid and small cap. So you could start off at something like a UTI Nifty 50, DSP, Nifty equal weight, a combination of these, and you could then move to PPFAS flexi cap, because it does have multiple large cap, mid cap, various market capitalization stocks. So you do get exposure to small. You also get exposure to international. So that's, I think, something like a next graduation for you from there. You could then move on to Kotak Emerging Equity. Again, good amount of large and mid exposure, but also small cap. So that's another great fund for you to be there. And next, you could then add up. So that's after a couple of years if you don't have that experience. But if you do have that experience already, you can start with this today itself. You can have like a 30 to 40% in large cap, 30% in mid cap, and 30 to 40% in your small cap, depending on your time horizon. But I would really urge you to extend the time horizon.
Okay, Shweta, thank you for highlighting all those details and giving a detailed answer to Shashi's query. But with this, let me move on to another caller. And Mahesh is joining us from all the way from Singapore. Hi, Mahesh. Thank you so much for calling us. We have Shweta on board. Go ahead and ask your query.
Hey, hi, everyone. Thanks for taking my call. So, yes, Shweta, I had a quick query around my mutual fund portfolio, which I just started in the last couple of years. So, I'm basically profile-wise, I'm an age 35 with a 3-year-old kid and an NRI for the past 10 years. So, my main investment objective is, reaching 5 crores in 15 years, which is permanently for my retirement fund. So, in terms of other investments, I have basically some real estate flats and houses and plots, which, account for 50,000 a month right now, which probably increases by 30,000-40,000 in the coming years. So, in terms of mutual fund, basically I've done my research where, there's a minimal overlap of the portfolio and different investment styles, risk ratio, returns, etc. So, just wanted an expert opinion on this. So my portfolio is Tata Small Cap and Quant Small Cap 10,000 each per month. HDFC Mid Cap and Motilal Oswal Mid Cap 10,000 each. SBI Contra Fund 10,000 and Tata Balance Advantage and HDFC Balance Advantage 40,000 plus 10,000. So I'm going a bit higher on the Tata Balance Advantage fund. just to cut out the high risk investment in the other mid cap and small caps and plus the contra fund. So it would be really helpful if you can guide me on the portfolio or any changes are needed. Thank you.
So he has shared his portfolio with us. He's 35 years of age and he also has some regular incomes flowing in, and he also shared his portfolio and the rationale behind putting more money in Tata Balance Advantage Fund. So what's your analysis? Is this portfolio sufficient to get him 5 crores in the next 15 years, which could actually help him plan his early retirement?
So Srishti, actually, Mahesh is right on target and right on track because he would need to invest 1 lakh a month to get to that magical number that he wants to. So he's right on track there. But some of the schemes like Tata Balanced, he is overexposed, so that will not help his cause because this is a 12% assumption, right? So balanced fund will not be able to beat that because it will have exposure to debt as well. So I would actually recommend a couple of things to him. One is definitely balanced advantage funds is something that he doesn't need in his portfolio. His time horizon is long enough to go into equity. He does have a good cushion of bank deposits there. So he can put this monthly amount into equity without really thinking that it is too much risk, right? So we are only seeing equity portfolio and we think that's too risky. But that may be a very small part of your overall portfolio, which is what I see here for Mahesh, right? So I think that's something that he needs to look at if he wants to get there on time. The other thing that I want to add to his portfolio is index funds. I'm not seeing index funds there, which is something that I would really like to add because I do see small cap and mid cap, but index is really not there. So I think the Tata Balanced and the HDFC Balanced funds can be stopped. And this amount instead should go to like a DSP Nifty 50 or a UTI Nifty 50 that he prefers. And that's something that he can build on. So he has a great passive, low cost, large cap, and as a core portfolio, right? So core of the portfolio it'll become. So I think that's really strengthening the portfolio, which is actually built quite nicely. So this is, I think, something if he can do, that's something that will really get him to his target, hopefully sooner than he wants to as well.
Okay, thank you so much, Shweta, for yet again giving a detailed answer to Mahesh's query. Mahesh, we hope that this resolves your query. And once again, thank you so much for connecting with us. With this, it's a wrap in this edition of The Money Show. Thank you so much, Shweta, for taking our time and helping all our viewers resolve their portfolio-related queries. But with this, viewers, it's a goodbye from me and the entire team who put the show together. Thank you so much for watching.